Big news, guys. There's a new report out by a very trusted source, SQM, that says that Perth in 2026 could rise up to 21%. That is hundreds of thousands of dollars of growth in Perth. They say Brisbane can grow 18%. Brisbane median price right now is $1 million. 18% means almost $200,000 of growth in 2026 in the property market. Darwin, 18%. Melbourne and Sydney up to 11%. That's hundreds of thousands of dollars. And Adelaide up to 18% as well. In this episode, we're going to go through 4 scenarios of what could happen in 2026 according to interest rate movements, according to economic recession or not, and also according to inflation outcomes. 4 scenarios across these 3 parameters, different permutations as to what the property market could look like. But how on earth will the property market keep growing? It's so hard for so many people to afford it. It's a big political hot topic. We're going to go through that as well using charts from Shane Oliver, a leading economist. Let's go, a lot to cover. My name's PK and I help people build passive income through the Property Investment Accelerator using data without needing a $15,000 buyer's agent every single time. This channel, we talk about the property, expose the reality about the economy, and discuss financial happiness. Hit the subscribe button if you get value, but definitely give it a like. Guys, we are going to go through city by city price growth predictions. But first of all, the topic that's on everyone's mind, affordability is shot. How can prices keep going up hundreds of thousands of dollars? Home ownership versus home prices relative to incomes. Let's look at this. Home ownership rates have been plunging. The ratio of average home prices to average annual wages has been going up, which means wages haven't been keeping up. This red line has been consistently going up since the turn of the millennium. Prices going up, wages not keeping up. And the ratio, therefore, of home prices to median household disposable income has been going up here in the green line. Ever since the value of the dollar was depegged in 1971 from gold, and of course in the 90s, financial deregulation, wages, it seems, just don't really matter when it comes to house price growth ceilings because there's so much debt that can be accessed, and of course the currency is worth less and less. I'm going to go through the exact predictions in a second, but check this. Years it takes to save a 20% deposit. Of course, you don't need a 20% deposit, but for benchmark's sake, since 1984, this has only gone up. It's now up to 11 years, and mark my words, by 2040, this could be hovering at about 20 years, yet the housing market will continue to go up. Why? Because of rampant inequality. If there's enough people that can afford houses, then they get bought. And with enough debt in the system, people who can afford to hold that debt, and of course with huge monetary easing. And I'm going to share a chart on that as well. It's crazy. And here's one reason why right now prices keep going up. Home construction versus population growth. Here's the annual population growth increase in the blue. You can see it's spiked up post 2022, 2023, and the red, which is dwelling completions, have gone down. Therefore, there's this huge gap, which means a chronic undersupply of houses. It doesn't matter about anything else. If there's more demand, which is the willingness and ability for people to buy something, than there is supply, then prices go up. That's what exists in a free market. Therefore, if you look at it from this graphical point of view, the accumulated shortfall of housing in Australia has only gone up since 2021, hence that massive price boom. Don't forget, that also was existing in the middle of the last decade, and that's why we also had a huge boom between 2013 and about 2016. These things are entirely predictable, and that's why these following predictions that I'm going to share in a second are entirely likely to come true. But before that, just one more chart from the Grattan Institute and Shane Oliver, population density. My hypothesis, amongst many others, of why house prices are so high in Australia is that our population density is so low. We don't pack enough people in together. Of course, no one likes to be packed in together. And one of the things we love about Australia is being able to have space. But the reality is Sydney, which is Australia's most populous and most highly dense city, is actually very low in the density equation compared to other places like Toronto, Rome, Dubai, Tokyo, London, Paris, New York City, and Barcelona. So we're not building enough high rises and attached dwellings. At least this chart would suggest. Now, without further ado, let's go to this prediction table by SQM. I share this every year, and by and large, they're pretty accurate every year. So don't be surprised if they actually get this right. Traditionally, they've been a bit more conservative. I find that this year, they're a bit more realistic. I would say scenario 1 is the base case, where there is a rate cut between 0.25 and 0.5%. There's a pretty slow economy, and inflation is about 2.5 to 2.75%. Right now, inflation is running hotter than that. And remember, when inflation runs hot, that means hard asset prices like real estate go up. That's always been the case across the world in terms of real estate correlated with inflation. And also remember, when interest rates rise, for those of you about to comment, but interest rates will rise, therefore property prices will fall. When interest rates rise, that in fact has no correlation to property prices. And I've shared a million charts about that in past episodes, especially around 2022 when interest rates started rising. And I was entirely correct, not because of my intelligence, but because of leaning on data. By the way, when interest rates rise, remember, builders' margins are also eroded. It's more difficult for them to fund debt, more difficult for them to fund construction. Therefore, supply drops even more. Therefore, there's housing crisis, supply shortage gets even worse, and house prices go up even more. Counterintuitively, right? Scenario 2, sticky inflation. No rate cut until late 2026. I think this is entirely possible, right? Inflation runs at 2.75 to 3.2 yearly average, which is at what it's at right now, and it's a slower economy. And scenario 3, global slowdown. Because there's a global slowdown or recession, there's actually huge interest rate cuts. 0.75 to 1% rate cut. Of course, rate cut means more borrowing capacity. So counterintuitively, a global recession means higher house prices. I know I sound like a spruiker, regardless of which way you cut it, house prices increase, but that's what the data has shown to be true over the last 80 years, at least in Australia and major developed countries. Unemployment rises to 5.5%, which, by the way, is still lower than long-term averages and still lower than when we experienced a huge boom in the middle of the last decade that I just went through before. Scenario 4, economic rebound. There's a cut in interest rates of 0.5 to 0.75%, lower inflation of 1.9 to 2.1, and unemployment back down to low fours. The scenario that I think is most likely, I'm going to be pretty pessimistic, okay? I'm not going to be optimistic for house prices, pretty pessimistic for house prices, is no rate cut until late 2026. Inflation stays at or a little bit above what it is now, and this economy is slower. In that scenario, house prices in Perth are likely to go up between 10 and 14%. Brisbane house prices are likely to go up between 8 and 12%. Darwin between 3 and 7%. We all know that's wrong. We all know Darwin's going to hit double digits regardless. Melbourne 2 to 6%. Once again, we all know that's wrong regardless of outcome, because there's markets within markets. We could go into a huge recession and there'll be pockets of Australia that boom anyway, just like in the GFC, places like Bendigo boomed anyway. It all comes down to local supply demand dynamics. Sydney 2 to 6%. I think this could be quite realistic. Adelaide 9 to 13%. If that happens, I think we could be in quite bubble territory in Adelaide. But I've been wrong before. I'm generally wrong because I say that house prices in a particular area are more difficult to continue to rise. Those are the areas I'm wrong because I'm very conservative and risk averse. I've never once been wrong in the last 7 years of content production, pre-COVID or post-COVID, on predicting a location that will rise that indeed ends up falling. That's never happened because of data, not me. Hobart, 3 to 7%. Hobart's showing a lot of green shoots. I mean, some of my clients are buying there as well and making a lot of instant equity. So I think that could be true. And in fact, some areas could be a little bit more. In Canberra, 1 to 4%. I wouldn't be investing in Canberra right now, but it is starting to shift. You know, Canberra had vacancy rates of above 2% just a year ago. Things are starting to shift. Now, if you are even more optimistic than me and you think there's going to be economic rebound, then strap in for boom times. COVID 2021-esque boom times in Perth, Brisbane, Darwin, in fact, Melbourne and Sydney, I think here are too conservative. If in fact rates cut by almost 1%, I think Sydney, Melbourne could boom more than 15%. Adelaide, huge as well, almost up to 20%. Hobart, up to 10%. Canberra would in fact take the entire U-turn. If you're more pessimistic than me and you suggest that there will be rate cuts, but amidst a huge global recession or global slowdown and unemployment rises, but to 5.5%, which is still low long term, then you find that Perth still booms, Brisbane still booms, Darwin still booms, Melbourne still booms. Sydney, well, you could call it a boom, 4 to 8%. You know, the rest were up to 10 to 12%. 4 to 8%, still relative long-term average category or territory. Adelaide booms 11 to 15%. Hobart booms 6 to 10%, and Canberra doesn't boom, just a little bit lower than long-term averages, which are around 7%. So overall, no matter which way you cut it, my advice to you, and I haven't finished this episode, one more chart left, my advice to you is get into the property market, get into the property market, get into the property market. Whether you're an investor, load up. Whether you're a first home buyer, of course, the government's giving you 5% deposit. Some banks are giving you the ability to just put down 10% deposit with no LMI. Use those options, because if you don't get in now, guys, you're not going to be able to get in for the foreseeable future in a lot of cases. Okay, guys, last chart. This is probably the most important chart. And for those of you who don't reach this far, you're missing a lot. You've just missed the most important thing. Here it is. Australian money supply, M1, this is currency debasement. They print money every year, even if interest rates don't go down. People don't realize this. And M1 supply, the amount of money swishing around, fake money, just dollar bills, electronic dollar bills swishing around, getting pumped into the market in Australia, has consistently risen, of course, since 1971. But you can see here between 2016 and 2025, 2026 going into now, it's consistently risen with peaks and falls, but it's so correlated with house price growth. The Australian mean dwelling price is this gray, and it's so directly correlated with Australian money supply. And by the way, you know what's happening right now with money supply? Yep, you guessed it, it's going up. Regardless of interest rates flatline, rise or fall, the Australian government needs money to fund a whole bunch of its initiatives, especially NDIS, which is woefully over budget. It's printing money, and therefore, if the tide lifts, all ships go up, regardless of what's going on with the storm situation, rain, hail, or shine. If the tide goes up, the water level goes up, doesn't matter about the economic environment, the weather, all ships rise anyway, and therefore property prices will rise. Guys, invest in yourself. The most important real estate is in the 6 inches between your 2 ears. No one cares about your money as much as you do. Not your auntie, not your colleagues, not your friends who don't really share what they're up to, but gloat about their millions in property. And definitely not that buyer's agent advertising you the world on Facebook, on YouTube. The ad might have just gone, right? Invest in yourself. To level up, I'll leave a link below to the Property Investment Accelerator below. You can buy property in the next month, DIY, through systematic education and training and a mentor, i.e. me. I'll never share with you my opinion. Everything's based on data, and that's how we get great results year on year, pre-COVID, post-COVID, post-COVID. Let's get it going. For free education, I'll leave a link to my Facebook group, Australian Property Mastery with PK. 70,000 amazing people, including all my clients. Get involved, make money, at least get onto the property ladder. You won't regret doing so. My name's PK. Hit the subscribe button and share it. I know people won't believe this episode. You got to share it because it will come true. See you later.